my worry is that the current environment where there's extreme monetary easing, largely through unconventional policies, in a world with substantial debt overhang and need for structural change constraining domestic demand, one could argue that a sizable portion of the effects of such policies spill over borders, sometimes through a weaker exchange rate, sometimes through capital flows. But more problematic is that these kinds of policies eventually prompt a reaction. And what we get is, in the immediate run, competitive easing, which occurs across the world. But over time, we get forms of competitive easing, which I think are detrimental to global demand. So with aggregate global demand weaker and more distorted than it should be, and financial risks higher, I worry that this kind of policy eventually becomes unsustainable. So my call is to rethink the international rules of the game as the world has changed. I think both emerging markets as well as advanced economies need to adapt, else I fear we're embarking on the next leg of a wearisome cycle, a cycle we've seen before. And so I title my talk differently from the one in the announcement. I call it Competitive Monetary Easing, Is It Yesterday Once More? Now, you will recognize that central bankers are usually reluctant to air their concerns in public. We have fora where we meet, such as the BIS. But occasionally, when the needed change has political elements to it, central bankers are not shy of airing their concerns publicly. And I take my cue from two central bankers whom I respect greatly, Ben Bernanke, of course, in his 2005 Global Savings Glut speech, and Jaime Caruana in his 2012 speech at Jackson Hole. And both these speeches essentially raised concerns similar to mine, though from different perspectives.